You know those loan offers that show up in your mailbox? The ones with the big, bold numbers promising you the world? Well, how much do those loans actually cost? Today, we're going to grab our detective's magnifying glass and decode what those offers are really saying. It always kicks off with something like this, right? A ridiculously low monthly payment that just seems too good to be true. It's designed to make you stop, to make you think, hey, I can totally afford that. This, my friends, is the bait. And that's the million-dollar question, isn't it? That one little number almost never tells the whole story. To figure out the true cost, we need to become financial detectives and start searching for the clues. And every good detective needs a toolkit, right? So we're going to use this simple 4-step filter to cut through all the marketing noise and find the real cost of any loan. Let's start the investigation. Okay, first things first, we're going to tackle that big, flashy number right on the front, the monthly payment. Lenders absolutely want you to focus on this, but honestly, it's often just a clever distraction from what really matters. So here's what you need to do. Hunt for the loan term, or what's sometimes called the tenure. That's just the total number of months you'll be making payments. Why? Because, and this is the trick, a super low monthly payment is almost always a sign of a super, super long loan. And here's where that trick really hits your wallet. Did you know that stretching a $10,000 loan from 3 years to 7 years can cost you thousands extra in interest? Look at this. On the left, a 36-month loan. Yeah, the payment's a bit higher, but check out the total interest you pay. Now look at the 84-month loan on the right. Sure, that monthly payment looks way better, but you end up paying, wow, sometimes double or even triple in interest over the life of the loan. That's the trade-off they're hoping you don't notice. Which brings us to step 2 in our investigation. We're now hunting for the single most important piece of evidence in any loan document, the APR. Seriously, if you take away just one thing today, this is it. The annual percentage rate, or APR, is the great equalizer. By law, lenders have to disclose it, and it's the only way to make a true apples-to-apples comparison between different offers. So why is the APR such a big deal? Well, because it shows you the difference between the bait and the real cost. The interest rate, that's just part of the story, but the APR, that tells you the whole story. And here's why. The APR doesn't just include the interest rate. It also bundles in all those extra mandatory fees the lender rolls into the loan. You know, things they call origination fees or processing fees. So a low interest rate with a high APR, that's a red flag that you're getting hit with a ton of hidden charges. And this brings us to the golden rule of loan shopping. Never, ever compare one loan's interest rate to another loan's APR. You have to compare APR to APR. It's the only way to know for sure which offer is actually cheaper. Okay, we've cracked the code on the loan term and the APR. For step 3 of our investigation, we need to ask a really important question. Is this rate locked in, or could it change on us down the road? So you've got 2 main flavors here. A fixed rate, that's your rock. It's predictable, your interest rate and your payment are locked in, and they're not going anywhere. But a variable rate, that one's a bit of a wild card. It often starts lower, which looks great, but it can rise if the market changes. And that means your monthly payment could jump when you're least expecting it. And, this is a classic marketing move. Of course, those mailers are going to shout about that super low starting variable rate. They are banking on you focusing on the right now and not thinking about what could happen a year or 2 from now. All right, we're on the home stretch. We figured out the big numbers. Now it's time to pull out that magnifying glass, get into the nitty-gritty of the fine print, and scan for those sneaky gotchas. When you're looking at that fine print, you're usually hunting for 2 main culprits. The first is a little trap called a prepayment penalty, and the second is any kind of sneaky add-on that's just designed to inflate your cost. So what's a prepayment penalty? Well, imagine you get a nice bonus at work, and you think, great, I'll pay off this loan early and save a bunch on interest. But wait. Some lenders will actually charge you a fee for doing that. It's crazy, right? You're basically getting punished for trying to get out of debt faster. And you've got to be on the lookout for those sneaky add-ons. Sometimes an offer will make it seem like you have to buy something extra, like credit insurance or some kind of protection plan. A lot of the time, these are just overpriced extras that do nothing but pump up the total amount you owe. And there you have it. Case closed. Let's wrap this all up with a final decoder checklist so you have everything you need in one place. Okay, here's your cheat sheet. Step 1, Find the tenure. That tells you how long you'll be paying. Step 2, hunt down the APR. That's your real total cost, fees and all. Step 3, know your interest type. Is it fixed or variable? This tells you if your payment is stable. And finally, step 4, scan for prepayment penalties. You want to know if you can get out of debt early without getting dinged. You find those 4 pieces of info, and you'll know the true cost of that loan. So the next time one of those shiny envelopes lands on your doorstep, you're going to be ready. You'll know exactly what to look for. You'll be able to tell the difference between a genuinely good deal and just really good marketing. The question is, will you see the bait or will you see the hook?